Hey there, Mad Money viewers! Today, we're diving into a topic that's often misunderstood and can lead to some serious financial missteps. Let's talk about a dangerous myth floating around, the idea that the stock market is a quick way to double your money. This misconception is not only misleading but can also be financially devastating. It's tempting. I know, the allure of making a quick buck can be very strong. But let me tell you, this get-rich-quick mentality is a recipe for disaster. Many people have fallen into this trap only to find themselves in a worse financial position than when they started. The stock market is not a casino. Unlike gambling where the odds are stacked against you, investing in the stock market requires research, patience, and a long-term strategy. It's not a magic money machine. You can't just put your money in and expect it to multiply overnight. The stock market is a complex system influenced by countless factors, from economic indicators to global events. It's a place to invest in businesses and participate in their growth over the long haul. When you buy a stock, you're essentially buying a piece of a company. Your investment grows as the company grows, and this takes time. The truth is, trying to time the market perfectly and score massive short-term gains is like trying to catch lightning in a bottle. It's nearly impossible and fraught with risk. It's incredibly risky and rarely works out the way people hope. More often than not, those who try to time the market end up losing more than they gain. Sure, you might get lucky once in a while. There are always stories of people who made a fortune overnight, but these are the exceptions, not the rule. But more often than not, you'll end up losing more than you gain. The market is unpredictable, and short-term gains can quickly turn into long-term losses. Remember, investing is a marathon, not a sprint. It's about building wealth over time through careful planning and disciplined investing. So stay patient, stay informed, and most importantly, stay invested for the long haul. When you buy a stock, you're not just buying a piece of paper. You're making an investment in a tangible entity, a company with real assets, employees, and a mission. This isn't just a fleeting transaction, it's a commitment to a business's future, or a digital ticker symbol on a screen. These symbols represent real companies with real operations, products, and services. They are not just numbers that fluctuate on a screen. They are the lifeblood of the economy. You're buying a piece of a real company. This means you are investing in its potential to grow, innovate, and succeed. You are putting your trust in its ability to navigate the market and deliver value. You become a shareholder, a part owner of that business. This ownership gives you certain rights and privileges, such as voting on important company matters and receiving dividends. That means you have a stake in their success, but also their failures. The company's performance directly impacts your investment, so it's crucial to stay engaged and informed. As a shareholder, you have responsibilities. You need to be proactive in understanding the business's financial health, strategic direction, and market position. You need to understand the business, its industry, its competitors, and its management team. This knowledge helps you make informed decisions about your investment. You need to stay informed about the company's performance and any factors that might affect its future. This includes keeping up with industry trends, economic conditions, and regulatory changes. That's right, homework is involved. Investing requires diligence and continuous learning. It's not a set-it-and-forget-it activity. This isn't gambling, it's investing. Unlike gambling, which relies on chance, investing is about making educated decisions based on research and analysis. It's about being a responsible steward of your financial resources and working towards long-term goals. Remember the story of the tortoise and the hare? Slow and steady wins the race. The same goes for investing. Patience is key. Don't expect to get rich overnight. Real wealth is built gradually over time through consistent investing and a long-term perspective. Think of it like planting a tree. You wouldn't expect to see a towering oak tree the day after you plant a seed. It takes time, care, and patience for that seed to grow into a strong, mature tree. Investing is the same way. Be patient, stay the course, and let your investments grow over time. Instead of chasing quick profits, focus on building a diversified portfolio that aligns with your financial goals and risk tolerance. Invest in companies you believe in, companies that have a solid track record and a bright future. And most importantly, give your investments time to grow. Remember, Rome wasn't built in a day, and neither is a successful investment portfolio. It takes time, discipline, and a commitment to the long game. By staying focused on your long-term goals and tuning out the short-term noise, you'll be well on your way to building lasting wealth. Section 5. Day trading delusions. Don't quit your day job. Now let's talk about day trading. It sounds exciting, right? The idea of making quick money by buying and selling stocks within the same day can be very appealing. You might imagine yourself as a financial wizard, making savvy trades and raking in the profits, buying and selling stocks rapidly, trying to make a quick buck off tiny price fluctuations. The thrill of the chase, the adrenaline rush of seeing those numbers change in real time can be intoxicating. It's like a high-stakes video game, except with real money on the line. Every click, every trade, feels like a move in a game where the stakes are incredibly high. But here's the reality. Day trading is incredibly risky, even for professional traders. The market is unpredictable, and even the most experienced traders can find themselves on the losing end. The vast majority of day traders lose money. Studies have shown that only a small percentage of day traders actually make a profit, and even fewer can sustain those profits over the long term. They get caught up in the excitement, make impulsive decisions, and end up getting burned. The emotional roller coaster of day trading can lead to poor decision-making and significant financial losses. Day trading isn't investing, it's gambling, plain and simple. Just like in a casino, the odds are stacked against you, and the house always wins in the end. So, my advice? Don't quit your day job just yet. Instead, focus on building a solid financial foundation through steady, long-term investments. Stick to a long-term investment strategy and you'll be much better off in the long run. Diversify your portfolio, invest in index funds, and be patient. Over time, these strategies have been proven to yield positive results, helping you build wealth without the stress and risk of day trading. Section 6. Apples and iPhones. Investing in what you know. One of the best ways to become a smarter investor is to invest in what you know. Do you love a particular brand of coffee? Are you obsessed with a certain tech gadget? Those are great starting points for investment research. Look into the companies behind the products and services you use and enjoy. Understand their business models, their competitive advantages, and their growth potential. By investing in companies you understand, you'll be more likely to make informed decisions and stick with your investments for the long haul. Section 7. Shareholder perks, more than just money. Being a shareholder isn't just about potential profits, it also comes with certain perks. Many companies pay dividends to their shareholders, which are essentially a share of the company's profits. It's like getting paid just for owning the stock. Plus, as a shareholder, you have voting rights on certain company matters. You get a say in how the company is run. It's a way to make your voice heard and participate in the future direction of the business. Section 8. Riding the roller coaster. Understanding market risks. Now, before you go all in on the stock market, it's crucial to understand the risks involved. The stock market is inherently volatile. Prices go up and prices go down. There will be good times and there will be bad times. That's the nature of the beast. Don't panic when the market takes a dip. It's completely normal. In fact, market corrections are healthy. They present opportunities to buy great companies at discounted prices. Remember, the key is to stay calm, stick to your long-term strategy, and ride out the volatility. Section 9. Keeping it real, slow, and steady wins the race. So let's be realistic about our expectations. Don't fall for get-rich-quick schemes. The stock market is not a casino, it's a place to build wealth gradually over time through informed decisions and a long-term perspective. Focus on building a diversified portfolio, investing in companies you understand, and riding out the inevitable market fluctuations. Remember, slow and steady wins the race. Section 10. The bottom line. Investing for a brighter future. The stock market can be a powerful tool for building wealth, but it's not a magic money machine. It requires patience, discipline, and a realistic perspective. Remember, you're not just buying stocks, you're becoming a part owner of businesses. So, do your research, invest in companies you believe in, and watch your wealth grow over time. Booyah!